So there's no such thing as a perfect investment product or strategy, but this is the index side of it. You've got growth potential, no or less downside risk. So you kind of end up in when you look at growing your wealth, growing your assets, the index side is kind of the happy middle. Welcome to How to Retire on Time, a show that answers your retirement questions. We're here to move past that oversimplified advice that you've heard hundreds of times. Instead, we want to dive into the nitty-gritty because the truth is there's no such thing as a perfect investment product or strategy. Nothing does everything well, so let's dive into the details and figure out what's right for you. Now, text your questions to 913-363-1234, and we'll feature them on the show. Remember, the show is not financial advice. Do your research. All right, David, let's dive in. What do we got today?
Hey, Mike, what's the difference between fixed, index, and variable life insurance?
Yeah, so this is where you need a dictionary to understand finance. I used to think that they just tried to make it confusing, so you'd have to blindly trust people. And then I realized, no, everything's complicated, and they're trying to dumb it down as best they can so everyone can understand it, but it is complicated, okay? So let's address it. Fixed. And by the way, these are typically referred to insurance products. Sometimes they will reference institutional products as well, but this is typically more on the insurance side of things.
Okay.
So fixed. What is fixed? It is a fixed contractual guaranteed rate of growth for a certain period of time.
Okay.
Think of a CD.
Yep.
Now think of a CD from an insurance company.
Okay.
There you go.
That's it.
That's it. Fixed.
Okay. So you could buy an insurance policy for 10 years, like that's the period, and they say this is the beginning and this is the end. And,
Yeah. So a CD is from a bank.
Mm-hmm.
A fixed annuity is basically a CD from an insurance company. And insurance companies need money too. So they're going to offer it to you. Now, because they need money in different ways than a bank might need money, you might be able to get sometimes a slightly better rate, sometimes a slightly worse rate through a fixed annuity.
Okay.
But you really don't want annuities. In my opinion, we won't talk too much about the tax side of it, but you don't put a non-qualified asset, so your brokerage money, your savings money, into a fixed annuity because the gains are going to get taxed as income.
Oh.
That's not tax efficient. So when you're looking at fixed rates for your IRA or your Roth, for example, maybe this is appropriate, maybe not, but fixed is a fixed growth rate. Now, that said, whole life insurance or universal life insurance is kind of a black box, but it's growing at around a fixed rate. It's not like saying they're guaranteeing 4% for life. It's their kind of, you're going to grow at a roughly stable or more steady rate, little engine that could, just kind of a more consistent, steady Eddie bet.
Okay.
So you're going to see it in all the insurance aspects. Sometimes it's a declared rate. This is exactly what you're going to get for this period of time. That's what you're going to see more on the time-based products like an annuity, like a 5-year or 10-year annuity. You know exactly how much you're going to get for the time period. But when you dive into permanent life insurance, they're not going to guarantee a certain rate for the rest of your life because they don't know what the rest of your life is going to look like. They don't know the underlying bond offerings 20, 30 years from now. It can be drastically different. So they're going to give you a rough fixed-ish rate or a steadier rate, and that's whole life or universal life on kind of what it would be. And it's a bit of a black box. Don't believe that an insurance company is being manipulated by it. They want to give they want to give you a better rate or the best rate that they can. They want you to be happy. But they also have to stay solvent.
Yeah.
So that's why there's a bit of a black box of they want to give you as best they can without getting too much over their skis, getting ahead of themselves and hurting themselves too much. And that will fluctuate over time.
And so you mentioned whole and universal. What's the difference? Are those very similar, whole life and universal
Permanent life insurance. Yep.
Okay.
So whole life insurance is more on, they're going to spread out. And this is my take on it. I'm oversimplifying a definition right now.
Yeah, we appreciate it. Yeah.
Permanent life insurance means you're going to get a death benefit for the rest of your life.
Okay.
How do you pay for that death benefit? Whole life insurance, as I'm interpreting it, is more like your fees are spread out for the rest of your life. So you're going to be paying a smaller amount for the rest of your life, and that's fine, okay? maybe at some point you could structure a whole life insurance to where you're paying it for a certain period of time and then it's done. And that arbitrary fixed-ish rate should take care of the fees and kind of take care of it until your end of life.
Okay.
Okay. Insurance is not an investment. It's just saying, hey, we want some sort of life insurance. We want the death benefit to stick around. If you needed it early on, then maybe you got a good ROI on it because the death benefit's there.
Mm-hmm.
But maybe later on, it's not as good of an ROI, but it's still you didn't give it up. Term life insurance, you're going to give up at some point. Permanent life insurance, you at least keep it for a while. But if you look at the internal rate of return or just the general return on investment, it might be like 2, 3, maybe 4% of how much money you put into life insurance at best with the cash value of the death benefit.
Okay.
It's not going to make you rich. When people say, well, I do my estate planning with life insurance, well, you're expected to die around, mid 80s or 90s.
Mm-hmm.
So if you look at the death benefit and then you look at the money you put in there, it's not that competitive. That's not how this works. But at least you didn't give it up.
Okay.
So that's kind of why people use permanent life insurance is you're not giving it up.
like you would in a term policy where you pay, and then as soon as the term is over, that's it.
Yeah, like
No
my
one
term
died.
life insurance, I expect to get nothing out of it.
Yeah.
But for my stage of life, that's appropriate, being my 37 years old.
Mm-hmm.
Personally, I'm transitioning to a more permanent life insurance
Mm.
because I can manipulate it the cash value side. It's not an investment. It's just, for me, it's a bond fund replacement. I want to grow the cash value. I might need a higher death benefit now for my spouse in case I were to die. But the death benefit sticks around. I can manipulate certain things. But that's the idea, fixed.
Okay.
Universal life, typically you're going to pay more in fees up front.
Okay.
So let's say you fund it over 10 to 15 years or so, but at some point you stop paying the premiums and the cash value is supposed to take care of the remaining cost of insurance throughout the rest of your life. It's just a
Okay.
different way that they've structured fees and funding
Okay.
for the life insurance policy.
All right. So whole versus universal, it's just fees and
And
how they're
Whole's more
structured.
old school, Universal's a little bit newer.
Oh.
So they're just slightly different. But
Okay.
it's unless indexed or variable are in front of it, you've got the Steady Eddie package.
Okay.
Now let's do indexed.
Yeah.
This is newer. Indexed products mean you've got growth potential with typically no or less downside risk.
Okay.
So
You can't lose the cash value.
typically there
Oh.
are index products where you could lose some of the principal
Mm.
and you got to account for fees as well. So let's do an fixed indexed annuity, which is, I think, a dumb name. I think it should be called an indexed annuity.
Yeah.
Here's why. An indexed annuity, I guess they do fixed index because there's a fixed component and an index component. You could pick between the two, but that overcomplicates. So let's just say an indexed annuity. Okay. An indexed annuity means you're going to get, let's say, up to 7% of the S&P or up to 10% of the S&P 500,
Okay.
but none of the downside. How does that work? It's a contract that's built around an underlining mechanism. They're using bonds, treasuries, to have some sort of protection, and they're using option contracts to give you upside potential. Not all the upside potential, but some upside potential, but less downside risk. It's a very complicated investment,
Yeah.
or not investment, but insurance product.
Yeah.
Okay. But if you look at a 5-year or a 10-year, you're getting some upside potential. You won't make as much on the up years, but you'll have less risk on the down years. So some people do like it for these purposes, and there's not always fees associated with them. Okay. Now that's the annuity side of the business. And after 5 or 10 years, your upside growth is going to fall off a cliff. It won't be nearly as competitive because the contract has changed. They don't know that you're going to keep the money in there for a long-term period of time. So you have to figure out what to do with that. And that's fine. There's a whole number of things you can figure out with that. But then you've got the life insurance, the permanent life insurance. So you have an index, let's say index universal life insurance. You've got more upside potential maybe than the fixed side of it. But you have no downside risk typically, but you're still going to pay fees. So there's still some downside exposure because if you don't make any money, you're still paying for the fees.
And what are the fees? What do the fees pay for?
Cost of insurance, so cost for the death benefit,
Oh.
cost of funding a policy, administrative costs. There's a whole slew of fees that you have to know that are happening. A lot of the fees, like for the first 5 years you'd fund a policy, there's going to be higher fees Then from year 6 to 10, at least for universal life insurance I've seen, you're going to have then the second highest phase of fees. After 10 years, you can typically, if you structure it right, have the lowest amount of fees, but there are still fees associated with the policy. Insurance is not an investment, but it may have a competitive cash component of growth to it with a death benefit. It's just the death benefit's not as good as it was originally. So there's no such thing as a perfect investment product or strategy, but this is the index side of it. You've got growth potential, no or less downside risk. So you kind of end up in when you look at growing your wealth, growing your assets, the index side is kind of the happy middle. You've got some protection, you've got growth potential. It's not guaranteed growth, but markets are typically up more than they're down. So you might outpace your fixed products. That's the idea.
Yeah.
Variable products.
Let me guess, do they vary?
Yeah.
Does the rate vary?
So variable products are going to be more around the upside growth. So you have essentially as much upside as you want, but you've also got the downside exposure too. So it's kind of like you've bought into the market and you're paying insurance fees along the way.
Oh, interesting. So if I just have my brokerage account at Schwab or Fidelity or wherever, then I'm buying into the market and
it's a variable return on your investment.
It can go markets go up and down.
Yeah.
So the variable life insurance kind of similar, but you're tacking on insurance fees.
Yeah.
Okay.
I mean, if you want a variable annuity, you're tacking on insurance fees for mortality.
Okay.
You're tacking on insurance fees for income, because if you want to turn on lifetime income, you're paying for that ability later on in life.
Oh, okay.
So there's insurance fees associated with it. So you're in the market with insurance fees, and you have to ask yourself, are those fees really worth it?
Yeah.
I personally am opposed to variable insurance policies, because if you're going to have the variable risk, you might as well be in the market, not be charged the fees. And then if you want some sort of income, then go into something else with less fees later on.
Okay.
I mean, I see an argument for you'd have a brokerage account or a non-qualified asset. So it's not a retirement account. It's not an IRA. It's not a Roth. You could put it into a variable annuity, for example, defer your taxes because annuities don't create capital gains, and then annuitize it for lifetime income. But there's just so many ifs. I've never actually sold a variable annuity for that reason. I've had to help people get out of variable annuities for that reason, because it's a huge tax problem. But all in all, you got to understand these terms. Fixed, it's a guaranteed rate of growth for a certain period of time, or an arbitrary for life, but it's not fixed. It's steady Eddie growth. Index, you've got growth potential, but maybe less downside risk. And it's the annuity, it's the index universal life insurance, but on the institutional side, you've got buffered ETFs, you've got structured notes, you've got other options. It's not just insurance products. It's just these terms are more often used for insurance products. And then variable, the return, the exposure is variable. It could go up or down.
Okay.
Do you think we missed anything?
No, we got it. Yeah. So we've to summarize, we have discussed the differences between those fixed, the index, and the variable, as far as life insurance and the annuity side.
Yeah, and what's right for you is going to be different than what's right for someone else. So don't ask, what's the right blend of all of this? That's not the question you ask. You put a plan together first, then you figure out what you could stomach. So let's say you're really concerned the markets are going to drop the next 2 years. Maybe for the income that you need, for the exposure you need, you just want to know that you're going to get 4 or 5% or whatever the fixed rate is. That's going to bring you some comfort. And so you put some of your money into a fixed investment for the next couple of years.
Okay.
Then maybe you put some of your other assets into the market, knowing that you don't need to touch it for 10 years. So if it does go down, it will still recover. Do you see how you're blending between the different definitions of fixed, indexed, or variable?
Yeah.
So you got to understand the underlying issues, the risks that you're taking, the trade. Nothing's going to give you everything that you want. So you got to blend things together. And the only way to blend things together or to create the right portfolio for you is really to start talking about, what does the plan look like? What's the financial plan? What phase of life are you in? Are you in your 30s looking to grow your assets as much as possible And you only need a little bit of protection in case you were to, lose your job. That can happen and get through. It's the emergency fund, but you don't need the emergency fund just to be in, you don't need it just in savings, high yield savings or whatever. You might use a life insurance policy, an indexed universal life insurance policy as a part of your emergency fund because you're trying to grow the cash value a little bit greater, and you want some death benefit because you don't want to pay for term life insurance. You want the cash value to grow and pay for. You can blend certain stuff like this. Maybe you want buffered ETFs so that if you need a little extra help for a couple of months, you can take it out and it's under long-term capital gains. Maybe that makes sense for you. Maybe your income is so high that that doesn't make sense for you because long-term capital gains sits on top of your income. Maybe all these questions need to be asked. And do you see how it's not just an investment question? It's not just a product question. It's also a tax question. It's all connected. And unless you can have a more comprehensive conversation, it's really hard to do this right. Hey, thanks for watching this video. Make sure that you like and subscribe first, and then go to www.retireontime.com to grab a copy of my book, How to Retire on Time, take a few courses about retirement, join my newsletter, and so much more. Now, if you want to work with one of our advisors here at Kedrick Wealth, who can help you put together a retirement plan that's designed to last longer than you, just click the button, Get Started. Everything we do is intended to help you retire on time. We hope you enjoy, and we'll see you in the next show.